Welcome to Simple Investing Secrets. In today's video, we'll review 10 wildly undervalued stocks to buy in 2023. So before we get started, please like this video and subscribe to our channel for weekly updates. Let's get started. A market downturn will always be the best time to shop for undervalued stocks, and 2023 is no different. With the S&P 500 down by almost 18% in 2022, investors should take advantage of this once-in-a-generation opportunity and snap up some oversold stocks before the economy's gears start turning again. In this tough economy, many good businesses are selling at big discounts because investors are getting scared and moving their money into safer assets. However, some of these are businesses with robust fundamentals that will stay relevant for years, if not decades, into the future. When the economy gets back on its feet, the people who bought shares in these businesses at deep discounts will be the ones to benefit. It can't be a coincidence that some of the most successful and respected investors are contrarians who bought when everyone was selling. Of course, it is impossible to predict when the market will bottom. It can still go down from here. But if you are looking to hold for the long term, buying oversold stocks is guaranteed to pay dividends, and short-term losses should not worry you. Most predictions say that the Federal Reserve will change its monetary policy in 2024, which is a year from now. The following 10 deeply undervalued stocks are set to take advantage of the ensuing bull market. Number 10. Apple, ticker AAPL. Apple has a solid business that will remain relevant for the foreseeable future. It is also much more resilient than other tech companies because it keeps hiring more people even though the market is going down. While most other undervalued stocks in the tech industry heavily rely on advertising revenue, Apple does not. As a result, the impact of declining ad revenue has been minimal for Apple. In addition, higher income folks make up the company's primary customer base. They are not as affected by high inflation, which is why Apple's sales keep going up. The company beat estimates, with revenue growing 8.1% year over year this past quarter and net income rising 0.8% compared to last year. These metrics certainly justify its current premium price-earnings ratio of 24.5 times. Investors in this market find stability and growth prospects compelling. Apple has both. It has shown exceptional resilience among FANG stocks, and its sales have a lot of room for growth. Apple's market share is still low outside the US and Europe, and these fast-growing economies could become major markets for Apple products over the long term. Number 9. Alphabet, ticker GOOG. Alphabet is down more than 33% year to date and is starting to become deeply undervalued at this level. The company is going through a difficult time due to declining advertisement revenue and broader economic pressures. So its falling earnings have led to a correction, which may be too big since its top line is still going up. Almost all companies have seen earnings compression due to inflation and economic turmoil, and so is Alphabet. But we think the company's earnings will get better as a result of layoffs and growth in the GDP. As the economy gets better, businesses will spend more on advertising, which will be good for Alphabet's bottom line. Moreover, the company's fundamentals are very solid and diverse. Alphabet sells much more than software nowadays, and the company won't fade out of relevancy anytime soon. Thus, investors should take advantage of the current downturn. One should also note that Alphabet's net income grew by as much as 166.2% year over year post-COVID. Profits must soon go back to more sustainable levels, so it is only natural that they are going down right now. Number 8. Netflix, ticker NFLX. Like Alphabet, the tech sell-off hit Netflix quite hard. To keep investors happy, the company had to compete with its 2021 metrics, which sent NFLX 73% below its peak within 6 months. However, investors are soon realizing that Netflix is performing much better than its peers. Most of the platform's subscribers from the pandemic era are still using it, and despite the decline, its finances are doing much better. For example, Netflix posted revenue of $5.5 billion in Q4 2019, which is now almost $8 billion and still growing despite headwinds. Over the trailing 12 months, the company's net income has gone from $1.9 billion to over $5 billion. Moreover, Netflix's subscriber count stands at 223 million, up from 167 million. Perhaps the only significant metric for Netflix that's below Q4 2019 levels is its stock price. Furthermore, Netflix is still cutting costs and plans to increase its profitability through ads. It is also getting more strict with password sharing, which can also increase its revenue over time. Investors recognize the opportunity, and NFLX stock has crept up 72% from its lowest point this year. Even then, this stock has more upside as it remains well below pre-pandemic figures. Number 7. Microsoft, ticker, MSFT. Microsoft is another one of the undervalued stocks we think will remain relevant in the long run. The company's products are too entrenched in people's everyday lives, and it is now almost impossible for white-collar businesses to run without Microsoft products. This ensures the company will have inelastic demand for a long time. Profit margins have taken a hit, much like those of most other companies. However, the current downturn presents a very compelling buying opportunity. When margins recover in line with the broader economy, a strong move to the upside is only a matter of time. Microsoft's top line grew 10.6% year-over-year to $50.1 billion, mainly driven by its cloud segment, which is now Microsoft's top source of revenue. Azure and other cloud services grew 42% in constant currency terms. When its bottom line starts to recover, we see investors willing to pay more of a premium for MSFT stock. Number 6. Bank of America, ticker, BAC. Bank of America has underperformed the overall stock market in the recent downturn, with shares 35% below their 52-week high. And there are some legitimate reasons. Most importantly, there is a chance of a recession, which could cause the number of people who don't pay back their loans to skyrocket and demand for new loans to drop. However, there are some benefits that come with the current economic environment that investors may be overlooking. The bank has a lot of deposits that don't pay interest and a low-cost overall deposit base, which makes it a big winner when interest rates go up. As benchmark rates and lending rates rise, so do Bank of America's profits. In fact, Bank of America's net interest income grew by $2.7 billion year-over-year in the third quarter, and management estimates it could rise by another $4.2 billion annually for every 100 basis point rise in rates. Bank of America is also doing a great job of building out its technology platform and has improved its asset quality dramatically over the past decade or so. With the bank stock trading at a historically low valuation of less than 1.1 times book value and 9 times forward earnings, Bank of America looks like a bargain for long-term investors. Number 5. EPR Properties, ticker, EPR. For the majority of the 2022 downturn, Real Estate Investment Trust or REIT EPR Properties, EPR, outperformed the market. But when its second largest tenant, Regal Entertainment, said it was going to file for bankruptcy at the end of summer, investors were worried. The stock is about 30% below the highs and has an 8.2% dividend yield. To put it mildly, the plunge in EPR stock price feels overdone. EPR leases 57 theaters to Regal, and these are generally high-quality theaters, meaning they are theaters Regal wants to keep open. The operator paid rent on all of its EPR leases in October and November. Even if a tenant is in bankruptcy, they usually still have to pay rent if they want to stay in the space. In addition, EPR has a strong balance sheet with $161 million in cash and an untapped $1 billion credit line. Plus, while the dividend yield is high, it is well covered by EPR's profits. In fact, the current dividend is only 72% of what the company is expected to make in 2022 from its operations. This is the REIT equivalent of earnings. This is true even though the Regal situation is uncertain. Number 4. Meta Platforms, ticker, META. While Meta Platform is seen by many as a falling knife due to its heavy investment in the metaverse, investors need to look deeper. Only a few people are excited about the metaverse, but the company is much more than that. Meta owns Facebook, Messenger, Instagram, and WhatsApp. We don't think that a company with so many popular platforms should be worth $295 billion. Moreover, the metaverse project is far from unsustainable. In 2022, Meta made $32 billion in operating profits from the family of apps, while it spent $9.4 billion on Reality Labs. The company is far from being unprofitable. Additionally, Meta has announced layoffs, much like other tech companies. That should help its bottom line stabilize until advertising revenue picks up again. Number 3. Stag Industrial, ticker, STAG. Many investors like to put their money into companies they know and love, like the big box retailers and discount club stores of the world. The stock was only $34.07 per share as of December 14, 2022, but the funds from operations number, the determining factor in determining the dividend this stock will pay out is $2.17 per share for the year ending in Q3 2022. With a multiple of 15.7, it falls well within the affordable range. Despite the lack of love from the market right now, Stag Industrial is killing it as a business. Not only does it have few debts compared to its assets, which gives it more financial flexibility when economic problems come up, but its funds from operations keep going up every year. This fundamental figure is up nearly 20% in Q3 2022 when compared to Q3 2021. This has been made possible by the smart buying and selling of industrial properties, disposing of those that weren't profitable enough and picking up some that promise to be long-term winners. A net gain of just over 3 million square feet of rentable space in hot markets like Atlanta, Fresno, El Paso, Portland, and Louisville will continue to push profits and FFO upward in the coming year. On top of that, the average occupancy rate has increased year over year, from an already winning 97.5% in Q3 2021 to 98.7% in Q3 2022. With tenants like Amazon, FedEx, and Ford Motor Company in industries that include logistics, industrial goods, consumer goods distribution, food and staples retailers, and healthcare equipment, it's not hard to see why Stag Industrial is a favorite for many REIT investors. Number 2. Prologis, ticker, PLD. Prologis is the largest publicly traded REIT by market capitalization and the largest industrial operator in the world. The company owns and leases nearly 5,000 industrial properties to high-quality tenants across 4 continents, and it usually trades at a premium, upwards of 25 times its FFO. But recent market volatility and concern that the demand for industrial space may be waning have pushed the stock down 24% this year. That means it's currently trading around 23 times its projected FFO for the full 2022 year. A REIT with a price to FFO of 23 times by REIT standards would be considered richly valued. But given Prologis' size and reach in a fast-growing industry, it's a great price for such a premier company. Prologis has outperformed the S&P 500 for the past 5, 10, 20, and 25-year periods while also growing its dividend by 490%. It has an A credit score, and a very conservative balance sheet, and is growing very quickly. In the third quarter of 2022, it achieved record levels of net rent growth, with rental rates being around 60% higher than the previous year. Its FFO rose by 66% year over year, while its net operating income increased by 9%. This type of growth in today's sluggish economy is absolutely staggering. Since there aren't enough good industrial properties around the world, Prologis has been able to keep growing. We believe the company can maintain this momentum for many years to come. Even if it stopped buying or building new properties, it could still grow its net operating income by double digits for a few years based on leases that are coming up for renewal in the near future. Number 1. United Parcel Service Incorporated, ticker, UPS. United Parcel Service, as its name suggests, is mostly a mail and package delivery service. With a fleet of approximately 121,000 package cars, planes, vans, tractors, and motorcycles, the company's air and ground services cover about 200 countries. In doing so, UPS has become a global leader in the freight and logistics industries. UPS is one of the best delivery services in the world, and in the more than 20 years it has been a public company, it has done very well. United Parcel Service's latest success story transpired over the course of the pandemic. UPS's stock price hit a low of about $90 when COVID-19 was declared a global emergency. The popularity of e-commerce helped the company grow after that. As more people shopped online and avoided in-store purchases, shares of UPS reached an all-time high of $233.72. In fact, UPS's services were so in demand that it could barely keep up with its own business. UPS became what is known as a pandemic play, as COVID-19 actually created a great deal of business for the company. However, as the light at the end of the pandemic tunnel grows brighter, it is becoming more obvious that UPS's growth was merely temporary. The pandemic pulled a lot of business forward, making it difficult for the company to beat estimates in future earnings reports. Now that inflation is going up and there is a chance of a recession, UPS is trying to get ready for a drop in deliveries. As a result, shares are down year to date. Down about 39.5% from their 52-week high, shares of UPS are trading at a discount to where they were this time last year. At its current price, UPS's price-to-earnings ratio is right in line with the industry averages of 12.91 and 11.08%, respectively. While the company's PE ratio is higher than the freight and logistics industry average, it's not by much. That means investors can buy shares of an industry leader for the same price as an average company in the same business. UPS hasn't yet proven it deserves to trade at a premium. After all, the company's latest earnings report acknowledged a drop in package volume. The number of packages shipped in the second quarter of this year fell by 4% in the United States and by more than 13% on a global scale. At the very least, fears of a recession and higher inflation rates prevent more people from shipping packages. Despite short-term headwinds, UPS still has a lot going for it. Adjusted earnings per share in the most recent quarter increased year-over-year from $3.06 to $3.29. Sales in the same period reached $24.8 billion, just barely beating analysts' estimates of $24.6 billion. The earnings beats were primarily the result of better profit margins. The CEO's plan to focus on quality over quantity led to a 0.4% increase in profit margins from last year to this year. Better margins helped the company make 12% more money per domestic package and 15% more money per international package. What is an undervalued stock? The concept of an undervalued stock is more or less subjective. Two different investors with unique strategies can look at a single equity and come to two different conclusions based on its valuation. On the one hand, an undervalued stock may be an equity that has been sold off due to an overreaction to an earnings report. On the other hand, an undervalued stock could just as easily be an equity with plenty of unrealized potential. Either way, underlying fundamentals typically suggest that undervalued stocks aren't priced accurately. When all is said and done, an undervalued stock is simply an equity with room to grow. This concludes our list of the 10 wildly undervalued stocks to buy in 2023. Before putting your hard-earned money into buying stocks or investing in the market, you should always do your research. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.